Hi, I'm Corey. I'm a CPA and subject matter expert in financial accounting. And in this video, we're going to run through everything you need to know about both tangible and intangible long lived assets. We'll start off with an overview to make sure we understand what long lived assets are. Next, we'll dive into the difference between tangible and intangible assets, discussing how to account for them and looking at some specific examples to get an understanding of some of the key accounting implications. You can think of assets as the value of resources that a company owns and uses in their business to generate future economic benefit. Things like cash, inventory, furniture, and equipment are all common examples. However, when we say long lived assets or long term assets, we're referring specifically to those resources that are expected to bring economic benefits into the future, usually greater than a 1 year time frame. Think of the types of assets you might possess if you owned a business. You might own some land, a building, and maybe some computer equipment. These would all be considered long lived assets, as the goal would be to use them over time to generate revenue in your business. Since you can see and touch them, the assets that we just mentioned would all be considered to be tangible assets. Companies also own long term assets that don't have any physical substance, called intangible assets. Things like patents, franchise rights, or trademarks. Long lived assets account for some of the largest values on a company's balance sheet, which is why it's extremely important that we get an understanding of how they impact the financials. There's three key accounting considerations that we want to be aware of when it comes to long lived assets. Firstly, the company needs to determine whether they can recognize the expenditure as an asset on their balance sheet or whether it needs to be an expense on their income statement. There's a set of criteria that's required in order to determine whether it meets the definition of an asset. Things like whether the company has legal ownership over the resource and whether it's expected to bring future economic benefit. If it meets this criteria, the company will be able to capitalize the cost as an asset on their balance sheet. This allows them to defer the cost over time as they actually use it in their business. However, if it doesn't meet the criteria, then it would be considered an expense, meaning that the company's profitability would be reduced in that period. Once the recognition piece of the puzzle is taken care of, the next step is to determine the measurement of the asset. This is the specific cost or value of the resource that will be recorded in the company's balance sheet. Regardless of whether we're looking at a tangible or intangible long-lived asset, businesses typically record long-lived assets at the historical acquisition cost, which is expected to be in line with the asset's fair value on the date that it was acquired. These acquisition costs will include the purchase price, but can also include all costs to bring the asset ready for use in the business. Let's take a look at an example. A storage company buys a forklift for $40,000, which they plan to use in their business over the next 5 years. They've already confirmed that it meets the criteria to be recorded as a long-lived asset. They have legal ownership and plan to use it in the business to generate revenue for more than 1 year. The next step would be to determine its initial measurement or cost at acquisition. Now, we know that the original cost of the forklift was $40,000. But let's say in addition to that, the company also spent $2,000 on taxes, $3,000 on transportation to ship the units to their facility, and another $1,000 to test and inspect the forklift. Since these additional costs would be considered part of the initial startup costs to bring the forklift ready for use in the business, they can all be included in the initial acquisition costs. Therefore, to determine the initial measurement of this forklift, we would include the $40,000, the initial purchase price, plus the additional startup costs for a total of $46,000 that would get recorded on the company's balance sheet. Now that we have a good understanding of long-lived assets, let's run through a few common misconceptions. We don't have to be able to physically see something for it to be considered a long-lived asset. These assets can also be intangible, meaning it lacks physical substance. While an intangible asset doesn't have the same type of obvious physical value as a tangible piece of equipment, it can still be highly valuable to a company. Many companies spend significant dollars on intangible assets, things like patents, brand recognition, copyrights, and software. Think about all the intellectual property in organizations that goes into developing their brand. Take a second to consider the last clothing or beverage purchase you made. A big part of this was likely based on the brand. While it can be more difficult to measure, companies can harness this value and report it as a long-lived intangible asset on their balance sheet. Now that we understand a little more about both tangible and intangible long-lived assets, let's talk about what happens after the asset initially makes it into the financial statements. If we circle back to the forklift example, at this point in time, there is $46,000 sitting on the balance sheet as the asset value, and there has yet to be any expense recorded. We need a way to reflect the expense as well as decline the value of the forklift over time. This is where depreciation comes in, which is the mechanism that allows us to slowly allocate the expense over time as the asset is used in the business. All long-lived assets that have a definite or known useful life are depreciated. This would be the case for the majority of both tangible and intangible long-lived assets, with the two exceptions being land value and intangible assets that have an indefinite useful life, meaning they never expire. Take a look at the chart on your screen, which demonstrates how this works with the forklift example. Say the business believes they can use the forklift for 5 years and it won't be worth anything at the end of its useful life. The blue line shows the value of the forklift decreasing in the balance sheet each year as it's used up, from $46,000 down to zero. Each year as the value declines, we would have a corresponding depreciation expense in the company's income statement. You can see this demonstrated with the orange line as the depreciation expense slowly accumulates to a total of $46,000 over the 5 years. The final step of this all would be to dispose of the asset once it no longer has any value or use to the business. This can be done by selling the asset to another party or by scrapping it and sending it off to the junkyard. At this point in time, the company needs to be careful since the sale can have an impact on their financial statements. If they're able to sell the asset for more than it's worth on the balance sheet, they would experience a gain or profit on the sale. However, if they're not able to recover the asset's current book value, they would experience a loss. This is why understanding an asset's value on the financial statements is so critical to an organization. And that brings us to the end of the video. Remember, long-lived assets are critical resources that give companies the tools they need to generate revenue and growth in their business over time. The ability to grasp and implement these topics can have a significant impact on the profitability and overall success of a company. If you're interested in learning more about financial accounting concepts like this, please feel free to check out our additional videos on Chegg for many more related topics.